standards on assurance engagements. Standards on, previous one is standards on review engagements. Now the point to be discussed is about standards on assurance engagements. There is another set of standards. There is another set of standards which apply to assurance engagements dealing with subject matter, matters other than historical financial information. In respect of historical financial information, you can either conduct audit or you can perform review. If you are conducting audit, you need to follow standards on auditing. If you are performing review, you need to follow standards on review engagements. If you are carrying out any work relating to matters other than historical financial information, then you are expected to follow some standards called as standards on assurance engagement. I don't want to explain this point further without providing another example. Have I ever explained you the concept of prospective financial information? Yes or no? Okay, try to understand this example. By this example, you can understand what is meant by prospective financial information. What is meant by prospective financial information? There is a company called as A Limited. A Limited approached State Bank of India for grant of a loan of 1 crore. In the given example, SBI is nothing but the lender, A Limited is nothing but borrower. Now SBI is made responsible to take a decision about whether to grant a loan of 1 crore to A Limited or not. In order to decide about this, first of all, SBI is required to focus on the repayment capability of A Limited, otherwise called as creditworthiness of A Limited. Only after getting satisfaction about the repayment capability or creditworthiness of A Limited, SBI can decide about whether to grant a loan or not to grant a loan. Therefore, in order to evaluate the creditworthiness or repayment capability, SBI asked A Limited to provide their last 3 years audited financial statements. A Limited provided last 3 years audited financial statements to State Bank of India. SBI analyzed the audited financial statements of the last 3 years and satisfied that A Limited is capable of making repayment of this loan. Assume that this loan is a term loan which is required to be repaid by A Limited over a span of 10 years. So now initially SBI is satisfied about A Limited's repayment capability if the loan is granted. So SBI decided to grant a loan of 1 crore to A Limited. But before disbursement of the loan, by SBI, before actual transfer of funds by SBI to A Limited, SBI got a doubt. This loan is required to be repaid by A Limited in the coming 10 years. Loan is required to be repaid by A Limited in the coming 10 years. We have gone through the audited financial statements of A Limited for the past 3 years. but repayment is required to be made over the coming 10 years. A Limited is capable of making the repayment only when it is able to get profits even for the coming 10 years. Yes or no? This is the thinking process of State Bank of India. This loan is required to be repaid over the coming 10 years. The company is able to make the repayment only when the company is able to get profits for the coming 10 years. Therefore, before disbursement of this amount of 1 crore, SBI asked A Limited to prepare their financial statements for the coming 10 years. What SBI? Yes, you heard it right. What SBI asked A Limited? SBI asked A Limited to prepare their financial statements for the coming 10 years. If A Limited prepares their financial statements for the coming 10 years, then SBI can go through such financial statements, can try to ascertain whether A Limited get profit in the coming 10 years, thereby whether A Limited is capable of making the repayment of this loan for the coming 10 years. So what is the duty of A Limited here? So now what is the responsibility of A Limited? A Limited is made responsible to prepare their financial statements for the coming 10 years. If you are made responsible to prepare your financial statements for the future, then such financial statements are technically referred to as prospective financial statements. As prospective financial statements. You need to forecast the future and you need to project the financial statements for the future. Therefore, in practice, we generally call these prospective financial statements as projections. What is that? Projections, otherwise called as projected financial statements. Projected profit and loss account, projected balance sheet are required to be projected profit and loss account, projected balance sheet for the coming 10 years are required to be prepared by the entity. Those projected financial statements can also be technically called as prospective financial statements. Okay. Now A Limited prepared some assumptions will be taken. Some assumptions will be taken for the purpose of preparation of projected financial statements, otherwise called as prospective financial statements. For example, what are the assumptions? I'll do one thing. I'll give you another example. You are required to provide your insight into that example. In the first year of operations, an entity is able to achieve a turnover of 1 lakh rupees. In the second year of operations, they are capable of getting a turnover of 1,10,000 rupees. This is the third year of operations. That entity wants to forecast how much would be the turnover of the entity in the third year based on the past data. How much would be the turnover of this organization in year 3 based on the turnover they have achieved in year 1 and year 2. Some people may provide an answer as 1,20,000 and wise people will provide an answer as 1,21,000. There is a lot of difference between 120 and 121. If you analyze the past data, your answer would be 121. If you fail to analyze the past data, your answer is 120. Persons who said 120 are looking only into abstract figures. They haven't analyzed the past data. Now start analyzing the data. What is the what is the value of sale in year 1? 1 lakh. You don't need calculator to calculate it. It is a simple calculation. What is the first year's turnover? 1 lakh. What is second year's turnover? 1 lakh 10,000. How much is the amount of increase? How much is the amount of increase in the turnover? 10,000. This increase of 10,000 on 1 lakh. 10,000 divided by 1 lakh into 100. So how much is the percentage increase? How much is the percentage increase in turnover? 10%. So there is a jump of 10% in turnover in year 2 when compared with year 1. Applying the same jump, assuming that there would be a jump of 10% again from year 2 to year 3, what would be the amount of turnover? 1,10,000 plus 10% of 1,10,000. 10% of 1,10,000 is 11,000. 1,10,000 plus 11,000. So probably the entity may be able to achieve a turnover of 1,21,000 in year 3. Year 3 has not yet started, but the entity is capable of projecting the turnover of year 3 at 1,21,000. How the entity is able to project a turnover of 1,21,000? Based on the past data, they made an assumption that there would be an increase of 10% in the turnover. By making that assumption, they have projected the turnover for year 3 at 1,21,000. Okay, so in this way, entities can prepare projected financial statements for the coming years. They are called either as projected financial statements or as prospective financial statements. In the given example, A Limited prepared projected financial statements for the coming 10 years. They are ready to submit these financial statements to the bankers. Because if you do not provide these projected financial statements, banker won't provide you the required funds. That is the reason why A Limited is about to submit these projected financial statements to the banker. But before submission of the same by A Limited to the bankers, A Limited got a doubt. Have we prepared these projections correctly? Have we prepared these projections correctly? That is the doubt of A Limited. Because they may be competent to prepare historical financial information. Because historical financial information is required to be prepared based on transactions which have actually happened in the past. But they are not competent to prepare projected financial statements. They prepared projections for the coming 10 years. They are not confident about their correctness. Management is not confident about the correctness of projected financial statements, otherwise called as prospective financial statements prepared by them. Otherwise called as prospective financial statements prepared by them. To get a confidence that they have properly made assumptions and properly prepared projected financial statements, they appointed you. You are a practicing chartered accountant. The entity appointed you, not for the sake of conducting audit of historical financial information, not for the sake of carrying out a review of historical financial information, but for the purpose of verifying whether prospective financial statements prepared by them have been correctly prepared by taking appropriate assumptions. In that case, the work carried out by you as a chartered accountant is to be technically called as as assurance. Here also you may provide some type of assurance, and hence they are technically called as assurance engagements. While you are performing assurance engagements, you need to follow some standards. Those standards are technically known as standards on assurance engagements. Now you can read this paragraph, and I am assuring you that you will be capable of understanding each and every word out of it without any further explanation. Do that. There is another set of standards which apply in assurance engagements dealing with subject matters other than historical financial information. Other than historical financial, here you are dealing with dash. Under standards on auditing, you deal with dash. Audit of historical finance. Here you are dealing with prospective financial information. Such assurance engagements do not include audit. They are not audit. They cannot be called as audit. They cannot be called as review. They are not audit of historical financial information. It is not review of historical financial information. These standards are known as standards on assurance engagements. For example, an assurance engagement relating to examination of prospective financial information. Enough. So sometimes, being a practicing chartered accountant, you may be made responsible to carry out a review of prospective financial information. In that case, you need to follow a standard called as Standard on Assurance Engagement 3400. Examination of prospective financial information. By this, we covered 3 points. First one is standards on auditing. Second one is standards on review engagements. Try to remember these points in the order in which we are discussing. So standards on auditing, standards on review engagements, standards on assurance engagements, and lastly standards on related services. This point is already made clear to you. Just a minute. It is to be noted that in such type of assurance engagements, such type of assurance engagements means engagements wherein you are made responsible to examine prospective financial information. Examination is not of historical financial information, or engagement may relate to providing assurance regarding non-financial matters. Sometimes you may be engaged by the organization in order to provide some assurance about non-financial matters like design and operation of internal control in an entity. When I say internal controls, you should be able to recollect the following things. Then only you will enjoy the discussion. You know very well about the importance of internal controls, which was explained to you earlier in an elaborative manner. I said to you earlier that management is made primarily responsible both for prevention as well as for detection of frauds and errors. In order to discharge their primary responsibility of prevention and detection of frauds and errors, the only alternative available for the management is to introduce some controls in the organization. Such controls that are required to be introduced by the management in the organization are technically called as internal controls. Simply speaking, through introduction of internal controls, management will try to either prevent or detect the existence or occurrence of frauds as well as errors. Then I explained you about what is internal control. There will be several phases in a single transaction. These things have been explained to you with the help of examples as well. I can't repeat all those examples. Just I want to have a brief explanation of what is internal control. There will be several phases in a single transaction. If one person is made responsible to carry out different phases of a single transaction, there is a high risk of occurrence of frauds. Risk of occurrence of frauds. I repeat, if there will be several phases in a single transaction. If one person is made responsible to carry out different phases of a single transaction, there is a high risk of occurrence of fraud. Why there would be a high risk of occurrence of fraud, particularly when one person is made responsible to carry out different phases of a single transaction? The person carrying out all the phases knows very well that he is carrying on all the phases of the transaction. Nobody is going to verify the transaction at a later point of time. So even if he involves in a fraud, since nobody is going to verify that transaction, the fraud perpetrated by him would not be identified by any person. So there is no fear to the employee. Because of lack of fear, employee tends to involve in fraud. That is the reason why I said to you and I proved to you that if there are several phases in a single transaction, and if you made one person responsible to carry out all the phases of that single transaction, then there is a high risk of occurrence of fraud, because in that case there is no fear to the employee. By listening to this, you should be able to recollect that frauds may take place because of lack of fear. So if you are able to create fear in the mind of the employee, obviously it will act as a moral check on the employee. Hence, the possibility of occurrence of frauds can be reduced or minimized by the organization. How to create fear by the management in the minds of the employee? For that purpose, management is expected to divide the responsibilities or to segregate the duties between or among more than one person in such a manner that the work done by one person is automatically verified by another person. If you arrange duties in such a manner that the work done by one person is automatically verified by another person, every person carrying out an activity knows very well that his work will be verified by some other person at a later point of time. So if you involve in fraud, since somebody is going to verify the transaction at a later point of time, the fraud done by you, the fraud perpetrated by you may be identified by some other person, and the same may be reported to the management, so that management will take either punitive action or corrective action immediately. Fearing punitive action from the management, the possibility of occurrence of frauds will get reduced. So then I said to you like this: internal controls are nothing but segregation of duties or division of responsibilities between or among more than one person in such a manner that the work done by one person is automatically verified by another person, for which an example is also given. I can't repeat that example. Then I said to you like this: actually, this is not the definition of internal control. This is the definition of another concept called as internal check. When I say this, you should get a doubt. Sir, you are saying that this is not the definition of internal control, but you explained this point as the definition of internal control. Why? Why? Because the actual definition of internal control is somewhat difficult to understand, and more importantly, the term internal control includes two things. The first one is internal check and the second one is internal audit. Both combined together is technically called as internal control. In other words, you can apply the definition of internal check even for internal control, because internal check is a part of internal control. That is the reason why I have given you the definition of internal check as the definition of internal control. Then I said to you like this: have I used the term dim earlier? I know that I have explained the meaning of the term dim. D means design, I means implementation, M means monitoring or maintenance. Monitoring or maintenance of internal controls. So management of the entity is made primarily responsible for designing internal controls, those designed internal controls are required to be implemented or to be introduced into the organization, then management is also made responsible to monitor, to maintain such established or designed and implemented internal controls. That is said to be the responsibility of the management. Fortunately, I even explained you about the responsibilities of the auditor in relation to internal controls. What is the responsibility of the auditor in relation to internal controls? It is your responsibility to check whether the entity had established effective. It is your responsibility as an auditor. It is your responsibility as an auditor to check whether the entity under your audit had designed and implemented effective systems of internal controls, and it is also the responsibility of the auditor to verify whether such established controls have actually been operated effectively. In other words, as an auditor, you need to verify three things relating to internal controls. What are they? Very good. The existence of internal controls, the continuity of internal controls, and the operating effectiveness of internal controls. So auditor's duty is to check whether there are internal controls, whether there are any internal controls are in existence in the organization. Auditor's duties also includes checking whether those controls are continued throughout the period of intended reliance, and auditor's duty is also to check whether those established controls have actually operated effectively. I also explained you some other point. Usually existence of internal controls shall be checked, very good, shall be checked by the auditor before commencement of audit, whereas continuity of internal controls and operating effectiveness of internal controls shall have to be checked by the auditor generally during the course of performance of audit. All these three things are technically known as compliance, very good, compliance procedures. The last two are to be technically called as tests of controls. Very good, very good. Why should the auditor do these compliance procedures? I even explained you 2 points relating to compliance procedures. If anybody asks you about what are compliance procedures, your answer should be like this. Point number 1, compliance procedures are the procedures relating to client's internal controls. Point number 2, when the auditor follows compliance procedures, auditor will try to focus on 3 important aspects. 1, the existence of internal controls. 2, the continuity of internal controls. And 3, the operating effectiveness of internal controls. Now the next question for consideration is, why should the auditor perform compliance procedures? To ascertain whether internal controls are in existence and whether they are operating effectively. Why should the auditor check the effectiveness of operating effectiveness of internal controls and others? Because if the auditor finds that the entity had established very good systems of internal controls, then the auditor can say that the possibility of existence of occurrence of frauds and errors will get reduced. Hence, the possibility of risk of material misstatements in the financial statements would also get reduced. Contrary to that, if the auditor identified that internal controls were not effective, then the possibility of occurrence of frauds will be more, and hence the possibility of existence of material misstatements in the financial statements would also be more. So, whether risk of material misstatement is high or the risk of material misstatement is low is dependent upon the effectiveness of internal controls. That is the reason why as an auditor we are made responsible to follow compliance procedures. And at this point of time, I even introduced you the heading of SA 315. What is the heading of SA 315? Identifying and assessing the risks of material misstatements through understanding the entity and the environment including internal controls. Actually, the term including internal controls won't appear in the heading part of SA 315, but it will be there in the body part of SA 315. I even gone through the original SA 315 and I have shown you that the term internal control is appearing in the body of SA 315. This is what you learnt about the concept of internal control till now. Yes or no? At this point, I want to introduce you some another concept called as internal audit. Then we can come back to our original discussion. I know very well that I am deviating from the original discussion, but understanding the concept of internal audit will become much easier for you at this point of time, and it will help you a lot in future. That is the reason why I want to explain you the concept of internal audit now itself. No doubt this will be explained under company audit also, while I am dealing with a particular section called as section 138. What is that? Section 138 deals with the concept of internal audit. Generally speaking, auditors can be classified broadly into two categories. The first one is external auditors, and the second one is internal auditors. We are going to have a discussion about who is an internal auditor and what are the objectives. What are the objectives behind appointment of internal auditor? For example, if you go through the provisions of section 138, if you go, I don't want to explain everything, but I want to explain 80% of 138. So if you are able to understand this discussion, it is said that we completed 80% of discussion on section 138 of the Companies Act. That will be useful for you to have better understanding of company audit, right? So according to section 138 of the Companies Act, some companies, some classes of companies are under obligation. Not all companies. Not all companies. Some classes of companies are under obligation to appoint not only an external auditor but also an internal auditor for the purpose of carrying out an audit called as internal audit. I repeat, according to section 138 of the Companies Act, some classes of companies are under obligation to appoint not only an external auditor but also another auditor called as internal auditor. The best example is section 138 mentions that all listed companies, what is that? All listed companies are under obligation. There is no option to them. They must have to appoint an auditor called as internal auditor. You know very well about what is a listed company. I even explained the meaning of the term listed company in the previous session. If the securities of a company, remember, the term security is different from shares. Do you know it? Excellent. The term securities includes shares, debentures, bonds, and other securities. Therefore, if the securities of a company were listed with a recognized stock exchange, such companies whose securities have been listed in a recognized stock exchange are to be technically called as listed companies. Once the company is a listed company, the company is under obligation to appoint two types of auditors. The first one is external auditor, the other one is internal auditor. Why should internal auditors be appointed? Or what objectives the company can achieve by appointing an internal auditor? Now, I will try to focus on this. These 3 points are very important, and these points is having a link with SA 610 also. But the points that I'm going to explain to you won't be there in SA 610. They were not given in your material, but they were given in the original standard. While I'm having a discussion on SA 610, I will show you the original standard, and if possible, I will show the original standard now itself to you so that you can understand that, okay, these are all the objectives which were mentioned under SA 610. The following three The following three are said to be the objectives. The following three are said to be the objectives behind appointment of dash, behind appointment of internal auditors. Objective number one, this is very difficult to understand, be careful. Internal auditor shall provide an assurance. Assurance means confidence. Internal auditor shall have to provide an assurance to the top level management. The basic objective behind appointment of the internal auditor is that internal auditor shall have to provide an assurance to the top level management that the data on which top level management is relying upon, the data on which top level management is relying upon to take key managerial decisions. You know very well that managerial decisions are required to be taken by top level management. In order to take such decisions, they need some information. They will make use of some information for the purpose of taking decisions. Yes or no? I repeat, the basic objective behind appointment of the auditor is that internal auditor shall provide an assurance to the top level management that the data on which top level management is relying upon, the data on which top level management is relying upon to take key managerial decisions is accurate, valid, and reliable. I'm assuring you that the data that you are going to make use of is accurate, is valid, is reliable. You can make use of that data for the purpose of taking any type of decision. That is the assurance that the internal auditor shall have to provide to the top level management. Can you please repeat that basic objective behind appointment of the internal auditor? Internal auditor shall provide an assurance to the top level management that the data on which top level management is relying upon to take key managerial decisions is accurate, valid, and reliable. I have already proved to you that the correctness or otherwise of any decision is dependent upon the correctness or otherwise of the information. Here also, top level management is making use of some information. If such information used by the top level management is accurate, valid, and reliable, any decision taken by them may prove to be correct. If the data itself is wrong, the decision taken by the top level management would become wrong. So if you were the top level management, what should you do before making use of any data? That's it. If you were the top level, most of you people are not listening to me. Instead, they are focusing on writing down what is being discussed. If you are the top level management, if you want to make use of any data, what should you do first? You need to check whether the data going to be used by you is accurate, valid, and reliable or not. Why should you check that accuracy, validity, and reliability of data? You know very well that the correctness or otherwise of your decisions would depend upon the correctness or otherwise of the data. That is the reason why before making use of any data, before making use of any information, it is the responsibility of the management to check whether the information going to be utilized by them is accurate, valid, and reliable. Unfortunate thing is that management may not have adequate time. Management may not have adequate time to do that. They may be having competence to do that, but they may not have adequate time to do that. That is the reason why usually this task of checking the accuracy, validity, and reliability of data shall be delegated by the management to a person appointed by them called as. So instead of doing themselves, they will delegate this responsibility to a person called as internal auditor. Now internal auditor is made responsible to provide dash to dash, to provide an assurance to the top level management. Probably you might have a better understanding of the objective now. So what is the basic objective behind appointment of the internal auditor? Internal auditor shall provide an assurance to the top level management that the data on which top level management is relying upon to take key managerial decisions is accurate, valid, and reliable. I want to extend the discussion to the next level so that I can even introduce SA 610. You will have some understanding about SA 610 as well. Okay. Assuming that you have been appointed as an internal auditor. Be careful. I am going to ask you a question. We have been appointed as the internal auditor. Just now, the accounts department of the organization prepared draft set of financial statements. You are the internal auditor of an entity. The entity in which you are working as an internal auditor, the accounts department of the entity in which you are working as an internal auditor, just now prepared a draft set of financial statements. They were not yet audited by dash auditor. They were not yet audited by external auditor. However, even before external auditors examination of such a draft set of financial statements, management of the entity wants to make use of such a draft set of financial statements for the purpose of taking some key managerial decisions. And before making use of the draft set of financial statements, management requires an assurance. Management requires an assurance that these draft set of financial statements have been accurately prepared, they are valid, and they are reliable. This aspect should be checked by the management, but management is not having adequate time. Hence, you have been appointed as an internal auditor. Now, this aspect is required to be checked by you as an internal auditor. What is your duty now? You need to verify the draft set of financial statements prepared by the accounts department. You need to ascertain whether such a draft set of financial statements are accurate, valid, and reliable. Then you need to provide an assurance to that effect to the top level management. Now, my question to you is, how do you ascertain, being an internal auditor, how do you ascertain whether draft set of, being an internal auditor, how do you ascertain whether the draft set of financial statements prepared by the accounts department are accurate, valid, and reliable? That's it. Financial statements correctness. That is the reason why I keep on doing like this for the past 1 minute. This is nothing but financial statements. Earlier I said to you like this. First of all, the organization will enter into a transaction. Later, the details or particulars of the transaction shall be recorded in a book called as a journal. Later, the particulars of the transaction shall be transferred to another book called as a ledger. At the end of the year, the ledgers are totaled, the ledger balances are extracted. From such balances of the ledger, organization do prepare a trial balance. And if such trial balance agrees, from such trial balance, organization do prepare financial statements. Now you are made responsible to check the accuracy of such financial statements. You know very well that correctness or otherwise of financial statements would depend upon the correctness or otherwise of trial balance. Correctness or otherwise of trial balance would depend upon the correctness or otherwise of ledger. Correctness or otherwise of ledger would depend upon the correctness or otherwise of journal. The correctness or otherwise of journal. And hence, being an internal auditor, you are also made responsible. I am not saying you are made responsible. I am saying you are also made responsible. Have you understood the importance of the term also here? The same thing will be done even by dash. Excellent. So being an internal auditor, you need to check journal first. You need to verify each and every entry recorded in the journal to ascertain whether it is genuine or is fraudulent, is real or is fictitious, for which even internal auditor is expected to perform a technique called as watching. Later, internal auditor is also required to check whether the entry recorded in the journal is correctly being transferred to ledger. That process of checking whether entry recorded in the journal has correctly been transferred to ledger or not is technically called as postings. So internal auditor is also required to perform techniques like watching, posting, casting. Have I explained you the term casting? Totaling, checking the arithmetical accuracy is technically called as casting. And finally, balancing, etc. By listening to this, every one of you must be in a position to understand that, okay, what are all the techniques that are usually expected to be followed? What are all the techniques that are usually expected to be followed by the external auditor may also be required to be followed by the internal auditor in order to provide an assurance to the top level management that the data on which top level management is relying upon to take key managerial decisions is accurate, valid, and reliable. Followed or not? Assuming that you are a statutory auditor, I am an internal auditor. Assuming that you are an external auditor, I am an internal auditor. Now you know very well that what are all the techniques, what are all the procedures that are generally expected to be followed by you have already been followed by me. Should I repeat this statement? What are all the procedures that are expected to be followed by the statutory or external auditor have already been followed by the internal auditor. In that case, there is no point. In that case, there is no point in repeating all those techniques or procedures by the external auditor. Instead, the external auditor may try to rely. The external auditor may try to rely on the work performed by the internal auditor, because the work to be performed by the external auditor and work that has already been performed by the internal auditor are one and the same. If you repeat that, it's a mere waste of time. No doubt you can repeat that. You are having an option. You can again check all these things independently, or else you could decide to rely upon the work performed by internal auditor. If you try to rely on the work performed by internal auditor, you can save some valuable time, and the time thus saved by the external auditor can be used to focus on some other important aspects of audit. That is the reason why usually during the course of performance of audit, in most of the cases, external auditors will always try to rely on the work performed by the internal auditor. But remember, if you just listen to me, after that, if you are having still a doubt, you can ask me. Okay, it is not yet completed, only we are in the halfway mark. So you cannot rely blindly on the work performed by internal auditor. You means external auditor. External auditor cannot blindly rely on the work performed by the internal auditor. What will happen if external auditor blindly relies on the work performed by internal auditor? External auditor might be made responsible for the faults done by internal auditor. Therefore, being an external auditor, although you want to make use of the work of internal auditor, you cannot blindly rely upon the work of the internal auditor. If you want to make use of, remember, it is not mandatory on your part. It is not mandatory on the part of dash to use the work of dash. It is not mandatory on the part of the external auditor to make use of the work of the internal auditor. However, if external auditor decides to make use of the work of the internal auditor, he can do so, but he cannot do so blindly. Before deciding whether to use the work of the internal auditor or not to use the work of the internal auditor, external auditor is expected to follow some audit procedures. After following such audit procedures, external auditor must decide whether to make use of the work of the internal auditor or are not to make use of the work of the internal auditor. Now you may get a doubt. If you don't get any doubt, it's of no use. What are the audit procedures to be followed by the external auditor in order to decide about whether to rely on the work of the internal auditor? They were mentioned in SA 610. Oh, yes, that is the link. They were mentioned in SA 610. By this, you must understand like this. Okay, whenever we are acting as an external auditor of an entity, and the entity under our audit is having some internal auditor, sometimes we may decide to rely on the work of the internal auditor. But you cannot do so blindly. Before taking a decision about whether to rely upon the work of the internal auditor or not, you need to follow some audit procedures. The audit procedures that are required to be followed by the external auditor when he wants to place reliance on the work of the internal auditor were mentioned in SA 610. The name of SA 610 reads like this: using the work of internal auditor. What is the heading of SA 610? Using the work of an internal auditor. So are you able to understand the importance of standards and auditing? You can't do blindly everything. First of all, you need to follow audit procedures that are mentioned in the relevant standards. Sometimes you may have to follow some additional audit procedures as well. Any situation which requires following additional audit procedure is to be decided by you based on professional skepticism. Excellent. I know very well that out of all of the students, 1 or 2 students are able to understand the relationship between this discussion and the term professional skepticism. In the earlier session, I said to you that all standards on auditing contain some audit procedures. Those audit procedures are basic or minimum audit procedures that are required to be followed by every auditor. However, sometimes the auditor may decide to follow some additional audit procedures. In some extreme scenarios, as an auditor, you might decide to follow some additional audit procedures. Such extreme scenarios can be identified by you only when you are maintaining professional skepticism. That's it. Are you able to understand the relationship? I am the external auditor, she is the internal auditor. Are you able to understand the relationship between external auditor and internal auditor? Say yes or no. If you say yes, I want to give you a statement. Then you need to specify whether you are able to understand that statement or not. Okay. Although the objectives behind appointment of internal auditor and external auditor are quite dissimilar. Objectives behind appointment of internal auditor and external auditor, they are not one and the same. They are quite dissimilar in nature. So, what is that? Means of achieving those objectives by those respective auditors is one and the same. I repeat, although the objectives behind appointment of the internal auditor and appointment of the external auditor are quite dissimilar in nature, the means of achieving those, the ways they follow to achieve those objectives are one and the same. That is the reason why I already proved to you that what are all the techniques, what are all the procedures that are generally expected to be performed by the statutory auditor or external auditor are already being performed by the internal auditor. Followed or not? Should I repeat the statement again? Although the not for writing, but for the sake of understanding, although the objectives behind appointment of statutory auditor and external auditor are quite dissimilar in nature, the means of achieving those objectives are quite similar in nature. What is the basic objective behind appointment of the statutory auditor or external auditor? To form and to express an opinion on the financial statements, whether those financial statements are free from material misstatements, and hence whether such financial statements are reflecting a true and fair view. That is said to be the basic objective behind appointment of an external auditor. Then what is the objective behind appointment of an internal auditor? Internal auditor shall provide an assurance to the top level management that the data on which management is trying to rely upon to take key managerial decisions is accurate, valid. Objectives are different, but to achieve those objectives, they will carry out some techniques or procedures which are quite similar in nature. That is the reason why there is no point in repeating the same procedures again and again. Instead, you can decide to rely on the work of the internal auditor, but you cannot do that blindly, and hence you are required to follow the audit procedures that were mentioned in SA 610. By this, I completed discussion on objective number 1 behind appointment of internal auditor. Now, objective number 2. Internal auditor is also made responsible to supervise internal controls. Internal auditor is also made responsible to supervise internal controls. What is meant by supervision? Internal auditor should check whether internal controls established by management are effective or not. Internal auditor should also check whether those established controls are operating effectively or not. These two are technically called as supervising internal controls. Management will simply establish controls. They don't check whether those established controls are effective or not, whether those established controls are really being followed by the employees. They may not have adequate time to do that. Are you able to understand this particular point? If you were the management, certainly you will design internal controls. Certainly you will implement internal controls. But you may not have adequate time to look back. You have established internal controls, but you may not have adequate time to check whether those established controls are effective or not, and whether those established controls have actually been operated or followed by your employees. When controls are ineffective, there is no use. When controls are effective but they have not been performed or followed by the employees, it's of no use. Therefore, it is the responsibility of the management to monitor them. But management is not having adequate time. Since management is not having adequate time, management is delegating the responsibility of supervising internal controls to a person called as internal auditor. Tell me, what are the objectives behind appointment of the internal auditor? Objective number 1, internal auditor is required to provide an assurance to the top level management that the data on which management is relying upon to take key managerial decisions is accurate, valid and reliable. Objective number 2, internal auditor is made responsible to supervise internal controls. Objective number 3, internal auditor is also made responsible prevention and detection of non-compliance with the provisions of applicable laws and regulation. In the previous session, I haven't explained, I repeated SA 250, responsibilities of the auditor, responsibilities of the management in relation to laws and regulations that are made applicable to them. This point was originally explained to you under SA 210. In SA 210, while the auditor is writing a letter to the management called as audit engagement letter, such a letter should include responsibilities of the management. Such responsibilities of the management also includes prevention and detection of non-compliance with the provisions of applicable laws and regulations. Okay, so management is made, నేను అంతే అలాగే చూసేస్తా, అంటే ప్రొఫెషనల్ స్కెప్టిసిజం 25 years నుంచి చెప్తున్నా కదా, కనీసం 35,000 మంది 40,000 మంది పిల్లల్ని చూసుంటాను ఆ కెరీర్లో. మీ మొహం చూస్తే మీరు ఏం చేస్తున్నారు, మీ మనసులో ఏం ఆలోచిస్తున్నారో కూడా చెప్పగలను. కాకపోతే క్లాస్లో చెప్పలేను, సభాముఖంగా చెప్పాలని వినాలనుకుంటే బయటికి రండి చెప్తా. Prevention and detection of non-compliance with the provisions of applicable laws and regulations is the primary responsibility of management. But due to lack of time, management may not be able to do that. Hence, the task of prevention and detection of non-compliance with the provisions of applicable laws and regulations will be delegated by the management to a person called as internal auditor. Tell me, what are the objectives behind appointment of an internal auditor? Internal auditor is required to provide an assurance. Internal auditor is made responsible to supervise internal controls. Internal auditor is also made responsible for prevention and detection of non-compliance with the provisions of applicable laws and regulations. Now, I will repeat the same statement. You will have a better understanding of the same. Although the objectives behind appointment of internal auditor and external auditor are quite dissimilar in nature, the means of achieving those objectives are quite similar in nature. Are you able to understand this? Now coming back to our original discussion. Sometimes an auditor may be engaged, a practicing chartered accountant may be engaged by an organization in order to get an assurance, may be made responsible to check design and operation of internal controls. A practicing chartered accountant may be appointed by an entity, not for the sake of conducting audit. In that case, the objective behind your appointment is that you need to check the design and operation of internal controls in the organization, and accordingly you need to provide some sort of assurance to the management. That is also technically called as standard on assurance engagement. I know now I am expecting that you are having some idea about what are standards on assurance engagements. So till now we have a discussion about three types of standards. The first one is standards on auditing. The second one is standards on review engagements. The third one is standards on assurance engagements. And the fourth one is standards on related services. Standards on related services. Sometimes a company may want to purchase another company. There are two companies called as A Limited and B Limited. A Limited wants to purchase the business of B Limited. Usually, purchase consideration is arrived at by calculating net asset value. Do you know the term meaning of the term net asset value? Net asset value is nothing but value of assets minus value of liabilities. The resultant figure is called as net asset value. Purchase consideration is based usually on net asset value. A Limited has gone through the balance sheet of B Limited and found that the total of the balance sheet of B Limited is 100 crores. The total of balance sheet of B Limited is total of assets of B Limited is 100 crores, out of which 99 crore rupees are in the form of debtors. Are trade debt, trade receivables. In that case, if that amount of 99 crores becomes wrong, then NAV calculated will become wrong. Then it results in payment of more amount of purchase consideration. Yes or no? Please say yes or no. Should I repeat this? A Limited wants to purchase the business of B Limited. Purchase consideration is required to be arrived at based on net asset value. Net asset value can be arrived at by subtracting value of liabilities from the value of assets. When you go through the assets of B Limited, you find that out of a total of 100 crore rupees, 99 crore rupees assets are in the form of trade receivables or debtors. If those trade receivable amounts or debtors amounts become incorrect, the NAV calculated by you will become incorrect. Then purchase consideration paid by you will be treated as excessive. That is the reason why before starting the process of identifying NAV, A Limited wants to ascertain the correctness of the trade receivables amount of 99 crore rupees. They may not have competence to do that. So what A Limited did is, A Limited appointed a practicing chartered accountant. Not for the sake of forming and expressing an opinion on the financial statements, but for the sake of examination of whether those trade receivable amounts that are being reflected in the balance sheet of B Limited are correct or not. So, being a practitioner, you are a practicing chartered accountant. Now you are made responsible only to check the quality and the correctness of the value of trade receivables. Such type of services, when the auditor provides to an entity, are technically called as dash services. Standards on related, anything which do not fall under the above three categories may be called as a category called as standards on related services. This is just like income from other sources head. If a particular income do not fall under the heading salaries, under the heading house property, under the heading PGBP, under the heading capital gains, obviously it is required to be shown under the heading other sources. Similar to that, if any particular point is do not fall under the above three categories, you can call it as a related service. Now, read it. Lastly, there are standards on related services. These standards apply in engagements to perform agreed upon procedures regarding financial information. For example, an engagement, this is what I explained to you. For example, an engagement to perform agreed upon procedures may require the auditor to perform certain procedures concerning individual items of financial data. Say, you may be made responsible to follow some procedures relating to accounts payable. You may be made responsible to follow some procedures relating to accounts receivable, relating to purchase from related parties, relating to sales, relating to profit of a segment, or sometimes even financial statements, say balance sheet, or even a complete set of financial statements. In that case, the service that you have provided is technically called as related service. When you are performing such related services, you need to follow some standards called as standards on related services. This is I don't want to explain what is about standards on quality control. That is very difficult to understand now, but I have already given a brief introduction to standards on quality controls. If you fail to maintain quality while you are conducting audit, what happens if an auditor fails? What happens if an auditor fails to maintain quality while performing his work as an auditor? If the work performed by you is not qualitative, then the report given by the auditor may not be said to be appropriate. When the report given by the auditor is not appropriate, then there will arise a risk to the auditor called as audit risk. So if you were the auditor, you will generally try to reduce your audit risk. If you want to reduce your audit risk, you need to provide an appropriate opinion. If you want to provide an appropriate opinion, then you must have to establish some controls in our practicing unit called as quality controls. So when practice unit, what is meant by practice unit? He is an individually practicing chartered accountant. It is called as a practice unit. I am a sole proprietor of a proprietary concern. Mine is also called as a practicing unit. These two are practicing in the name and style of AB and Co, a partnership firm. Theirs is also called as a practicing unit. Every practicing unit had to establish some controls called as quality controls, otherwise called as quality control policies and procedures. That was dealt with in SQC1. There is only one standard on quality controls, that is SQC1. There are several standards on auditing, but there is only one standard on quality controls. What is the only standard on quality controls? SQC1. Of course, there is one more standard called as SA 220 that I don't want to explain it now itself, but I will explain it later once we complete SQC1. So there is only one standard relating to quality controls as of now, that is SQC1. That I will explain under SQC1, not here. That's it. Only when you are able to understand these things, it will become easier to understand what is given in your material. Okay. Before proceeding to what is given in your material, just go through this flowchart and try to understand the flowchart. If you perform an audit of historical financial information, you need to provide a dash assurance, and hence such type of engagements are known as dash reasonable assurance engagements. If you perform review of historical financial information, then you are expected to provide not a reasonable assurance but a limited. Have I explained you the term limited assurance? There are three levels of assurance: absolute assurance, reasonable assurance, limited assurance. In an audit, you are required to provide reasonable assurance. In an investigation, you can provide an absolute assurance. In a review engagement, you can provide only a limited assurance, because audit procedures that are required to be followed while you are performing a review engagement are lesser than audit procedures that are required to be followed when you are performing an audit engagement. Number of audit procedures to be followed in an audit are more than number of procedures to be followed by the auditor in a review engagement. That is the reason why as an auditor you are expected to provide only a limited assurance when you are performing a review of historical financial information. Even after explaining this much, I know very well that some of you people may not be able to understand this flowchart. If you are unable to understand this flowchart, it means that you need some more practice of those 3 points. Go through those points which are appearing in our material so that you can easily understand this. Limited assurance engagement. Assurance engagements dealing with matters other than, here it is assurance, reasonable assurance. Here it is limited assurance. Here it is assurance engagements dealing with matters other than historical financial information. It is nothing but prospective financial information or assurance regarding operations of controls. Regarding operation. That is the reason why I explained to you that sometimes management may get a doubt whether those controls established by them are correct or not, for which a practicing chartered accountant may be separately appointed to review such controls. That is also called as an assurance engagement. That's it. Now, examples of assurance engagements. Audit of financial statements. Reasonable assurance engagement. Review of historical financial statements, a limited assurance engagement. Examination of prospective financial information. It provides assurance regarding reasonability of assumptions. When I say assumptions, are you able to recollect the 10%? First year 1 lakh, second year 1,10,000. In the third year, it may be around 1,21,000. What was the assumption made by the management in that case? 10%. What is your duty as an auditor? You need to verify whether that assumption made by the management is reasonable or not. And then you need to provide an assurance to that effect. Provides assurance regarding reasonability of assumptions forming basis of projections. Actually, in the original standard, the term original discussion, the term projection is not used. Instead, the term prospective financial information is used. But I used the term projections as well as prospective financial statements only to ensure that you'll have an understanding of this explanation. Okay. So, examination of prospective financial information provides assurance regarding reasonability of assumptions forming basis of projections and related matters. And this point is also explained to you. Report on controls operating at an organization. This also provides assurance regarding design and operation of controls. Are you really, be honest, are you really able to understand this flow chart and this table? Very good. Now you can also understand, try to understand this point. Types of assurance engagements. In audit of historical financial information, you will provide a reasonable assurance. Yes or no? In review of historical financial information, you will provide a limited assurance. Yes or no? In case of the third type, what is the third type? Standards on assurance engagements. Then also you need to provide some sort of assurance. Yes or no? So in the first three cases, you are supposed to provide some type of assurance to the users. Yes or no? Read it. Types of assurance engagements. Sometimes it may be a reasonable assurance engagement. Sometimes it may be a limited assurance engagement. There is one more word that you can use instead of the term limited assurance engagements. If it is given in the material, I will explain it. Otherwise, I won't. Okay. As already discussed, assurance engagements provide assurance to dash to the users. The difference is of degree. Difference between reasonable assurance and limited assurance is of degree. Reasonable assurance is a high level of assurance, but not as high as. Are you able to recollect SA 700? In SA 700, auditor declared to the users that he is giving only a reasonable assurance. Although auditor is giving only a reasonable assurance, it is also a high level of assurance, but not as high as a reasonable, not as high as an absolute assurance. Very good. As already discussed, assurance engagements provide assurance to the users. The difference is of degree. Reasonable assurance engagements like audit. Reasonable assurance engagements like audit provides reasonable assurance, which is also a dash, a high level of assurance. Limited assurance engagements like review provides lower level of assurance than audit. It is only a moderate, not high level. It is a moderate level of assurance. Now go through this table. Reasonable assurance engagement and limited assurance engagement. Reasonable assurance engagement provides dash, high level of assurance. Limited assurance engagements provides dash level of assurance, lower level of assurance than reasonable assurance engagements. In a reasonable assurance engagement, auditor, the person doing the engagement, shall have to perform elaborate and extensive procedures in order to obtain sufficient appropriate audit evidence. Whereas in a limited assurance engagement, the person performing limited assurance engagement is expected to perform fewer procedures as compared to reasonable assurance engagement. Have I explained this point earlier? In a reasonable assurance engagement, the person carrying out that engagement will be able to draw reasonable conclusions. Whereas he can draw only dash conclusions in limited assurance engagements. Limited conclusions. An example of reasonable assurance engagement is an audit engagement. An example of limited assurance engagement is a review engagement. Besides reasonable assurance engagements and limited assurance engagements, there is another kind of assurance which is related to matters other than, historical financial information. Such an assurance may be related to what is given in this table. The table is a summary of this discussion. That's it. That is the reason why I'm not trying to explain anything. I am expecting you people to recollect these things. Such an assurance may relate to prospective financial information and not to historical financial information. It may even relate to providing an assurance on internal controls in an entity. What is prospective financial information? It means financial information based on assumptions about events that may occur in future and possible actions by an entity. It can be in the form of a forecast or in the form of a projection or a combination of both. Actually, I generally explain the term forecast, but I miss it to explain that point to you. And here the term forecast is appearing. So I'll try to distinguish between the terms forecast and a projection. There is a difference between the terms. Usually people use it interchangeably, but there is a difference between the terms forecast and a projection. For the past 3 days, there was a rainfall of 10 centimeters in Vijayawada. And what would be the rainfall for the current day? It may be around 10 centimeters. You have expected that, వింటున్నావా? నిద్ర వస్తుంది ఇప్పుడే. నువ్వే you have expected that today's rainfall would be around 10 centimeters. How you are able to expect today's rainfall at 10 centimeters? Based on the past data. Based on the data for the past 3 to 5 days, you started anticipating that today also there would be a downpour, there would be a rain to the tune of 10 centimeters. Yes or no? If you do that, it is technically called as forecast. Forecast is based on past data. Forecast is based on past data. In the example that I gave to you, in the first year, the organization got a turnover of 1 lakh. In the second year, the organization got a turnover of 1,10,000. And I asked you to expect what would be the turnover of the company for the third year. You said it as 1,21,000. That 1,21,000 is nothing but a dash. A forecast. It is nothing but a forecast. You have expected that 1,21,000 based on past data. So if you are able to expect something based on past data, it is technically called as dash. Forecast. A thing which is not a forecast is called as projection. Just now you started your business. You haven't carried out any business operations in the past. In the current year itself, you started a business. You approached a banker for the purpose of taking a loan. Then banker asked you to provide last few years financial statements. You said that, sorry sir, we started our business in the current year itself, so we haven't prepared any financial statements yet. Then the banker asked you to prepare projected financial statements. You need to prepare projected financial statements. While preparing such projected financial statements, do you have any data available for the past? No. You have to anticipate everything. Then it is called as projection. Are you able to understand if you are at least able to understand the meaning of the term forecast, you can easily understand the term projection. What is not forecast is called as a projection. What is forecast? If you do anything based on past data, it is called as a forecast. The reverse to that is called as a projection. It is this is also known to you. It is to be noted that in such type of assurance engagements, examination is not of historical financial information. Here, it is important to note the difference between historical financial information and prospective financial information. The former relates to information expressed in financial terms of an entity about economic events, conditions, etc. occurring in the past periods. The latter means prospective financial. What is historical financial information? Historical financial information is nothing but information expressed in financial terms about economic events, conditions or circumstances occurring in the past periods. The latter relates to financial information based on assumptions about occurrence of future events and possible actions by the entity. Therefore, historical finance, enough. And now, finally, the thing which is given in your material, elements of assurance engagements. Unless you understand what has been discussed till now, it is quite difficult for me to explain the topic called as elements of assurance engagements. Although this is the only point given in our material relating to this particular topic. I have taken your time to explain those things to ensure that you'll have a better understanding of this particular point. Elements of and now there is no need for me to explain anything about assurance engagements. Okay. Following elements comprise an assurance engagement. In an assurance engagement, usually there will be three parties. In an assurance engagement, there will be three. Take the example of an audit. In an audit, there are three parties. Entity appointing the auditor himself, and users of financial statements. Have you observed three parties in that audit? Are you able to understand this point? In an audit, there will be three parties: entity, auditor, and users of financial statements. Following elements comprise an assurance engagement. A three-party relationship involving a practitioner means CA, a responsible party, and intended users. You know very well about practitioner. You know very well about intended users. Then what about responsible party? That's it. So there are three parties involved in an engagement called as assurance engagements. An assurance engagement involves above said three parties. Who are they? 1. Practitioner. 2. Responsible party. 3. Intended users. A practitioner is a person who provides the assurance. Usually it is a chartered accountant in practice. The term practitioner is broader than auditor. A person conducting audit is called as auditor, whereas a person who is providing other assurance engagements like checking of prospective financial information cannot be called as auditor because he is not conducting any audit. Therefore, he is technically called as practitioner. Should I explain it again? If you are carrying out audit, you will be called as auditor. If you are carrying out examination of prospective financial information, you are not carrying out audit. You are just examining prospective financial information. In that case, you cannot be called as auditor. You can simply be called as . So, the term practitioner is wider than the term auditor. An assurance engagement involves above said three parties. A practitioner is a person who provides the assurance. The term practitioner is broader than auditor. Audit is related to historical information, whereas practitioner may provide assurance not necessarily related to historical financial information. A responsible party is the party responsible for preparation of the subject matter. Who is responsible for preparation of prospective financial information? Management. So management is said to be a responsible party. Intended users are the persons for whom an assurance report is being prepared. These persons may use the report in making decisions. This is first element of an assurance engagements. In our material, probably initially this may have been given. The following are the elements of an assurance engagement. In an assurance engagement, there will be a relationship. Who are those parties? 1. Practitioner. 2. Responsible party. And 3. Intended users. The second one is an appropriate subject matter may be historical financial information. Subject matter may be prospective financial information. Subject matter may be checking the design and effectiveness of internal controls, whatever may be the subject matter. An appropriate subject matter. What is subject matter? It refers to information to be examined. Information to be examined by the practitioner is technically called as subject matter. For example, financial information contained in financial statements is said to be dash. Financial information contained in financial statements is said to be dash. Subject matter. When you are conducting dash, audit of financial statements. And in order to carry out assurance, there should be some criteria to be followed by the auditor. What criteria should the auditor follow? For carrying out assurance engagements, auditors should follow standards. Standards means engagement standards, guidance notes, laws, rules, and when you are conducting audit, you are expected to follow standards on auditing. Standards on auditing is nothing but a part of engagement standards. You should also check whether the entity had complied with all laws and regulations. Against that criteria, you will perform your work. Against that criteria, you will perform your work. That is called as suitable criteria. Sufficient appropriate audit evidence is well known to you. I don't even want to read that. The practitioner performs an assurance engagement to obtain sufficient appropriate evidence. It is on the basis of evidence that conclusions are arrived. It is on the basis of evidence that conclusions are arrived and opinion is formed by the auditor. This is nothing but a new definition of audit evidence. Can you please say what is the new definition of audit evidence? Audit evidence can be defined as any information used by the auditor in arriving at conclusions on which auditor's opinion is based. That point is nothing but new definition of audit evidence. Read it again. The practitioner performs an assurance engagement to obtain sufficient appropriate evidence. It is on the basis of evidence that conclusions are arrived and an opinion is formed by the auditor. Sufficiency relates to quantity of evidence obtained by the auditor. Appropriateness refers to quality. Evidence is said to be qualitative when the evidence is very good, relevant, very good, reliable. Relevant and reliable, then it is said that evidence is qualitative. I don't know whether I have used the term quality or not, but the first one deals with quantity and hence the second one deals with quality. Appropriateness relates to quality of evidence obtained by the auditor. One evidence may be providing more comfort to the auditor than the other evidence. The evidence providing more comfort is qualitative and therefore appropriate. Evidence should be both sufficient and appropriate. Which evidence is more comfortable to the auditor? Is it external evidence or internal evidence? Is it external evidence or internal evidence? That is the reason why I explained you about reliability standards of audit evidence, otherwise called as generalizations of audit evidence. He is saying that what is comfortable to you is to be considered by you as appropriate. And finally, you need to provide your assurance in the form of dash, in the form of a report. A written report is provided by a practicing chartered accountant, which should contain conclusions that conveys the assurance about the subject matter. What may be the subject matter? Historical financial information may be a subject matter. Prospective financial information may be a subject matter. Internal control may be a subject matter. You need to form and to provide an assurance about that subject matter. A written assurance report is the outcome of an assurance engagement. Now, if anybody asks you like this, what are the elements of an assurance engagement? Your answer should be like this. There will be a three-party relationship in an assurance engagement. Auditor is practitioner is required to check the appropriate subject matter against a suitable criteria. Criteria means checking of the subject matter should be carried out. Checking of the subject matter should be carried out by following standards, laws, regulations, guidance notes issued by the CA Institute, etc. And while doing an assurance engagement, you are expected to obtain sufficient appropriate audit evidence. And finally, you need to report you need to provide your assurance in the form of a report. These are all technically called as dash elements of an assurance engagement. Topic number 17, assurance engagements, its essential elements and types. Engagement in which a practitioner expresses an opinion to enhance the degree of confidence of the users other than the responsible party about the outcome of evaluation of measurement of a subject matter against criteria. Essential elements, three-party relationship, what are the parties given, appropriate subject matter, suitable criteria, sufficient appropriate audit evidence. Assurance engagements are audit of financial statements, reasonable assurance, review of financial statements, limited. This point has already been shown to you.